Here's a question I want you to sit with for a second. If your portfolio lost 50% tomorrow, that means half of your money gone. How would you feel? What would you do? Your answer to this determines everything about your financial future. Charlie Munger, Warren Buffett's longtime Berkshire Hathaway partner, had a famous line on this. He said, and I'm paraphrasing here, if you're not willing to watch your portfolio cut itself in half 2 or 3 times during your investing lifetime without panicking, you're not fit to own stocks, and you'll earn the mediocre returns that you deserve. Now, that's a hard thing to hear, but I think it's one of the most honest things I've ever heard someone say about investing. Here's what most people don't realize about a 50% drop in the market. It's not a black swan event. It's not a once-in-a-generation catastrophe that you could have avoided if you were smart enough or careful enough. It happened. It happened in 2000. It happened in 2008. Berkshire Hathaway itself, one of the greatest companies ever built, lost more than half of its value during the financial crisis of 2008. Amazon had multiple 50% drops. So has Apple. These weren't bad investments. They were the best investments in the last 30 years. The drops didn't define the outcomes. The behavior during the drops did. The investors who got hurt weren't the ones that owned the stocks. They're the folks that sold the stocks during the market bottoms. They saw the headlines, they saw the red, and they made an emotional decision at exactly the wrong moment, locking in permanent losses and missing the recoveries that always historically have happened. Munger's point is that the market will test you, probably more than once, and the test isn't about your portfolio, it's about your psychology. All right, so that's great, the rah 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 speech, but how do people prepare? Here's a few things. Number 1, know your actual risk tolerance before the storm hits. Not the tolerance you think you have on a calm day, the real one. If a 20% drop would make you lose sleep, you probably own too many equities, and we need to have a conversation. Second, make sure you have liquidity. If you have cash set aside for your near-term needs, you're never forced to sell stocks at a bad time. That's the whole point of a bucketing strategy. It can be long-term money because your short-term needs are covered in your short-term cash bucket. Third, separate the business from the price. If the company you own still has strong fundamentals, strong leadership, and a long runway, a drop is information about investors' fear. It's not about the business. That's a potential buying opportunity, not a reason to flee. Okay, now here's the flip side, and it matters just as much as everything we've already covered. If you can't tolerate any volatility, you'll migrate to things like cash, bonds, and CDs. And these things have a role in everyone's portfolio. But over the long run, returns that don't meet inflation aren't going to build any wealth for you. They're just preserving that feeling of safety while your purchasing power gets eroded. Caution isn't free. It's a real cost. What Munger was saying was the price of admission to real wealth building is the willingness to temporarily endure pain. Most people aren't willing to pay that price. That's why most people get average results. The market will drop again. I don't know when. Nobody does. But I do know that the investors who are prepared for it emotionally and structurally, who have a plan, have liquidity, and understand why they own what they own, those are the ones who come out on the other side better than what they went in. Charlie Munger lived this. Berkshire Hathaway lived this. And the clients that I've seen navigate the downturns best were the ones who had a framework ahead of time before the fear hit. If you want to talk about whether your portfolio is built to handle what's coming, whatever that turns out to be, that's exactly what we do.